While most people panic during a recession, the wealthy are out there quietly making millions. How? They don't fear downturns, they leverage them. In this video, you'll discover exactly how the rich turn crashes into cash and recessions into opportunities. These aren't theories, these are the real strategies billionaires use to grow even richer when the economy tanks. Let's dive in. Economic downturns often spark fear, uncertainty, and financial losses for the average person. Recessions tighten budgets, shrink job markets, and make investing feel risky. But for the wealthy, downturns are often seen not as disasters, but as golden opportunities. While most people panic and pull back, the rich double down, take calculated risks, and position themselves for long-term gains. Their wealth isn't just a cushion, it's a launchpad. The truth is, the world's wealthiest individuals and families didn't just survive downturns, they thrived because of them. In this deep dive, we'll uncover the exact principles, strategies, and mindset shifts the wealthy use to turn recessions into riches. You'll learn how they identify hidden value, move with confidence, and build wealth while others play defense. If you've ever wondered how fortunes are made when the market crashes, this is the blueprint. 1. Understanding the wealth mindset during crisis. The first and most crucial difference between the wealthy and the average person is mindset. Where the average person sees danger, the wealthy see discounts. Where the average person sees loss, the wealthy see leverage. The wealthy understand that market cycles are natural. Booms are followed by busts, and recessions are inevitable. Rather than fear them, the rich prepare for them. Many even anticipate them. This mindset is rooted in long-term thinking. Wealthy individuals rarely think in terms of months. They think in decades. Emotional control. They don't make decisions based on fear or panic. Opportunity obsession. Downturns are seen as windows to buy undervalued assets, talent, or businesses. Warren Buffett's famous quote sums it up perfectly. 2. Cash is king. Liquidity as a weapon. During recessions, cash becomes power. When asset prices crash, those with liquid capital can swoop in and buy prime investments at a discount. The wealthy keep significant cash reserves or easily liquefiable assets for this very reason. They don't just wait, they prepare. It's not about hoarding money for no reason, it's about being ready to strike when opportunity knocks. Examples: during the 2008 financial crisis, billionaires like Warren Buffett made massive investments in struggling companies like Goldman Sachs and Bank of America, securing favorable deals. In 2020, when the market plunged during the pandemic, smart investors scooped up stocks at record lows and watched their portfolios rebound dramatically by 2021. 3. Acquiring distressed assets. Recessions cause panic selling. Businesses go bankrupt. Real estate gets foreclosed. Stocks get dumped. And this is exactly where the rich hunt for value. Distressed assets, those undervalued or sold in desperation, are gold mines for those who know how to spot them. Key areas of focus include real estate. When housing markets crash, wealthy investors buy properties at rock-bottom prices. These properties often double or triple in value once the market recovers. Businesses, small and mid-sized businesses hit hard by downturns often sell for a fraction of their worth. Wealthy buyers step in, restructure, and flip them post-recovery. 4. Investing in innovation and disruption. Downturns often accelerate innovation. Old industries collapse, new ones emerge. And while the masses focus on stability, the wealthy look to the future. When Airbnb launched in 2008, people thought it was crazy. Who would rent a stranger's home during a housing crash? When Uber launched in 2009, the economy was still recovering, yet it disrupted the entire transportation industry. The wealthy invest early in startups and industries that thrive post-crisis. They look for tech disruptors, AI, green energy, biotech, new consumer trends, remote work, health, e-learning, government-supported sectors, infrastructure, EVs. They don't just invest in what's hot, they invest in what's next. 5. Buying the dip in the stock market. Market crashes terrify most people. But the wealthy often see them as clearance sales. Historical data shows that the stock market has always recovered, often stronger than before. The S&P 500, Dow Jones, and Nasdaq may drop 30 to 50% during a crash, but they eventually rebound and surpass previous highs. Smart investors. Dollar cost average during downturns. Buy blue chip stocks at discount. Double down on index funds while they're cheap. Think about it. If a company like Apple or Amazon loses 30% of its value during a crash, but its fundamentals are strong, that's a gift for long-term investors. Conclusion: the crisis playbook of the wealthy. The wealthy don't have magic powers. They don't predict the future. But they do have a playbook, one that turns crisis into capital, chaos into opportunity. They prepare. They stay liquid. They invest in people and assets. They use every tool, credit, taxes, timing, to their advantage. And most importantly, they see every downturn as a setup for the next big leap. So the next time the market crashes, the headlines scream fear, and uncertainty looms, ask yourself, will you panic? Or will you play like the wealthy? Because fortunes aren't just made in bull markets, they're built when the rest of the world is running scared. If you found this video valuable, hit that like button, subscribe for more wealth building secrets, and tap the bell so you don't miss the next money making move. Thanks for watching, and keep playing the long game.